In April 2025, $6.6 trillion vanished from the US stock market in 48 hours. Not transferred, not seized, not spent, gone. The largest two-day wealth destruction event in recorded market history. And the thing that nobody stopped to ask, the thing almost nobody ever asks, is the obvious question: where did it go? Because here's the uncomfortable answer: it didn't go anywhere. It was never quite there to begin with. That's not a metaphor. That's architecture. And understanding how money can disappear without being spent is one of the most important things you'll ever learn about how the financial system actually works, because the mechanism that makes money vanish is the same mechanism that created it in the first place. Let's start with what most people think money is. You work, you get paid, the number in your bank account goes up. Simple input, simple output. But that number in your account isn't a pile of cash sitting in a vault with your name on it. Your bank doesn't have your money. It has a record of a promise. When you deposited $1,000, the bank kept a fraction, in many cases, literally 0% since 2020, when the Federal Reserve dropped reserve requirements to nothing and lent the rest to someone else. That person spent it. It landed in another bank. That bank lent most of it out again. This is the core loop. One real dollar enters the system, and through repeated lending, it becomes $5, $10, $15 of recorded balances spread across the economy. Every bank account, every portfolio statement, every net worth calculation you've ever seen is built on this layered architecture of promises, not lies, promises. There's a difference. Until there isn't. The money that gets created through this cycle is sometimes called credit money. It's not counterfeit. It's not a glitch. It's the actual operating system of modern finance. The Bank of England published a paper stating plainly that commercial bank lending is the principal means of creating money in the modern economy. Every time a bank approves a mortgage, a business loan, a credit line, it doesn't reach into a vault and hand over someone else's savings. It types a number into an account. New money, created at the point of lending. And credit money has a property that physical currency doesn't. It can be uncreated. When a loan gets repaid, the process reverses. The dollars that were conjured into existence through lending simply evaporate back into the ledger. That's normal. That's the system breathing in and out. But during a panic, this breathing becomes hyperventilation, and then it stops. Here's how the cascade works. Start with an asset, say a house. In 2006, a house bought for $200,000 was appraised at $400,000. That extra $200,000 wasn't imaginary. Banks lent against it. People took home equity lines of credit. They used that borrowed value to spend, invest, or buy another property. Each transaction created new deposits somewhere in the banking system, which enabled more lending, which inflated more asset prices, which enabled more borrowing. The loop fed itself. Then the price dropped. Not because anyone spent the money, not because the house caught fire. The market simply revised its opinion about what the house was worth. And when that appraisal fell from $400,000 back to $250,000, $150,000 of lendable collateral vanished. Every loan backed by that inflated value became unstable. Every deposit created by that loan chain became suspect. The money didn't move. The confidence underneath it simply dissolved, and every layer built on top of that confidence went with it. During the 2008 financial crisis, U.S. households lost roughly $11 trillion in wealth. Stock portfolios dropped $7.4 trillion. Real estate shed another $3.4 trillion. Retirement accounts across the country shrank by an average of $66,000 per household. And the critical thing to understand is that nobody took that money. No one has it. There's no vault somewhere stuffed with $11 trillion that fell out of American bank accounts. The wealth existed only as a consensus, a shared agreement about what things were worth. And when the consensus broke, the numbers on the screen simply got smaller. This is the part that breaks people's mental models. We're trained to think of money as a substance, like water. It flows somewhere, and if it's not here, it must be there. But credit-based wealth doesn't work like water. It works like temperature. When a room gets cold, the heat doesn't relocate to another room. The energy dissipates. It simply becomes less. Market value during a panic works exactly the same way. Think about it like health points in a game. Your character sheet says you have 100 HP, but HP isn't a physical object you're carrying. It's a system-generated number based on your character's level, their equipment, their buffs. Change any of those underlying variables and the number changes instantly. You don't lose the HP to someone else. The system just recalculates. Market value works the same way. It's a real-time calculation based on what the last buyer was willing to pay. When buyers vanish, the calculation collapses, and every unit of wealth derived from that price collapses with it. But here's where the architecture gets truly interesting. The disappearing act doesn't stop at your brokerage statement. It feeds back into the real economy through a mechanism most people never see: the credit contraction cycle. When asset prices fall, banks are suddenly holding loans backed by collateral that's worth less than what they lent. Regulations require them to maintain certain capital ratios, basically a minimum gap between what they owe and what they own. As asset values drop, that gap shrinks, and banks have two options: raise more capital, which is nearly impossible during a panic because who's investing in banks when everything is falling, or lend less. They pull back credit lines, they reject loan applications, they call in existing debts. And when banks lend less, the entire money creation process shifts into reverse. Fewer loans means fewer new deposits. Fewer deposits means less lending capacity. Less lending means less economic activity, which means lower corporate earnings, which means lower stock prices, which means less collateral, which means even less lending. The spiral tightens. Each turn destroys money that was created on the way up. This is what happened in the spring of 2025. When tariff announcements triggered massive uncertainty, investors didn't just sell stocks. They sold the idea that future earnings would be what everyone had assumed. Bond markets, normally the place investors flee to during stock sell-offs, started crashing too. The 10-year Treasury yield swung violently, spiking from 3.86% to 4.5% in less than a week. When even the safe haven isn't safe, the architecture of confidence itself starts to fracture. Now here's the part that matters for anyone trying to understand their own position in this system. The wealth that disappears during a panic was always conditional. It existed as long as everyone agreed it existed. Your house is worth what someone will pay for it tomorrow. Your portfolio is worth what the last trade priced it at. Your net worth is a real-time snapshot of consensus, not a vault of accumulated value. This doesn't mean the wealth was fake. Credit-based money does real things. It builds real houses, funds real businesses, pays real salaries. The factory that got built with a loan doesn't unbuild itself when the bank's stock drops. The salary you earned last month doesn't retroactively disappear. But the system's accounting of aggregate wealth, the total scoreboard, exists in a fundamentally different way than most people assume. It's not stockpiled, it's circulated. It's not stored value, it's flowing confidence. And when the flow stops, the value doesn't get redistributed, it gets uncreated. There's a useful distinction here between what you might call settled wealth and consensus wealth. Settled wealth is the cash in your pocket, the paid-off car in your driveway, the skills in your head. It doesn't fluctuate with market sentiment. Consensus wealth is everything whose value depends on what someone else would pay for it tomorrow. Your home equity, your stock portfolio, your retirement account. Most people's net worth is overwhelmingly consensus wealth, which means most people's financial identity is a live calculation, not a fixed number. The reason this matters isn't fear, it's design. Once you understand that most wealth in the system is layered on confidence and credit rather than sitting in some permanent repository, you start making different structural decisions. You start asking better questions. How much of my net worth depends on a single consensus holding? How many layers of credit are between me and actual liquidity? What happens to my position if the system recalculates? These aren't doomsday questions. They're engineering questions. And the people who build financial resilience aren't the ones predicting the next crash. They're the ones who understood this architecture before the recalculation happened. Here's the final irony. After every panic, the money comes back. Not the same money. That was destroyed. New money, created through the exact same lending cycle, the exact same confidence loop, the exact same architecture of layered promises. The S&P 500 recovered its April 2025 losses within months, but it recovered to a new consensus, built on new assumptions, with new layers of credit underneath it. The system doesn't learn, It just rebuilds the same structure and waits. If this kind of breakdown changes how you see the system, you should subscribe to 8-Bit Economics. Every week, we strip complex financial mechanisms down to their core architecture. No hype, no predictions, just the underlying code that most people never get to see. Hit subscribe, like this if it shifted your thinking, and drop a comment with the financial concept that makes the least sense to you. Because there's a good chance the answer is structural, not complicated. By the time everyone sees it coming, the smart play is already over. So the next time a headline says trillions were wiped out or destroyed in a market crash, remember, no one took that money. No one spent it. No one hid it. The system simply did what it was designed to do. It recalculated, and the number got smaller. The real question isn't where the money went. The real question is whether you understood what it was made of before it disappeared.